Good morning. I'm Tom Cosgrove, Senior Vice President of Public Affairs and Knowledge Exchange at Farm Credit East, and welcome to today's webinar on the dairy farm summary and current dairy situation. So certainly we all know the headlines for 2015, that it was a difficult year, especially compared to 2014, and 2016 is shaping up to be even tougher. So the goal of today's webinar is to really get beyond the headlines to take a closer look at farm financial data in the dairy farm summary. What's it telling us and what can we learn from it? But then we also want to step back and talk with some of our senior managers to react to the dairy farm summary findings and results and discuss what are some of the ways to manage through the current situation. So the first part of today's session is the presentation of the dairy farm summary results. So I'm pleased to introduce Chris Laughton, our Director of Knowledge Exchange. Chris is a native of Massachusetts, attended the College of Agriculture at Cornell, and has an MBA from the Eisenberg School of Business at the University of Massachusetts Amherst. After Chris's presentation, we're going to take a few questions on the dairy farm summary results themselves, and then I'll introduce a panel of our lenders for the second part of the discussion. So with that, I'm going to turn it over to you, Chris.
Thanks a lot, Tom. Thank you and welcome to everyone who's online for this webinar. Welcome to the Northeast Dairy Farm Summary webinar. We're going to discuss the financial results of what's known as the Blue Book, affectionately, and then we will have a panel discussion about where we go from here. So to start off, here's a few highlights of this year's dairy farm summary. Okay, here we go. So once again, we had excellent participation. We had nearly 500 farms, which makes the dairy farm summary a remarkable research project for the Northeast dairy farm industry. We have a tremendous cross-section of farms that participate, and there's tremendous diversity among regions, sizes, and management types that allows us to really get a good overall perspective of the Northeast dairy farm industry. Unlike a lot of projections and things like that are put out there that are estimates or surveys or that kind of thing, this is an actual summary of direct financial results from actual dairy farms in the Northeast region. And we have a tremendous cross-section, so it makes it really a rather unique research project. Obviously, it's not news to anyone that 2015 was a very different year than 2014, as Tom mentioned. We went from perhaps what was the best year in 20 years to a year that was really disappointing. Profitability, depending on how you measure that, and we'll talk about that a little bit later, declined by 99%, falling by more than $1,100 per cow in 2014 falling by nearly $1,100 per cow from 2014 to 2015, resulting in a roughly break-even year. This, of course, was driven primarily by falling milk prices. The milk price fell from an average of $25.58 in 2014 to $18.24 in 2015, a decline of over $7 per hundredweight, which is really significant. Several expense categories did decline as well, which did help, but not nearly enough to preserve producer margins. Per cow productivity increased and overall milk production was up as well, despite these negative market signals. So also debt per cow increased by about 10%. This was driven by a number of reasons, some of which was due to expansion or improvement spending, some of that which was planned in 2014, but some was also due to capitalizing operating losses. And this is not just farm credit loans, this is overall debt per cow, which includes things like trade credit and other obligations. So here we have a slide that shows farm milk prices per hundredweight over the last 20 years. The red line is the milk price per year, and the blue line is the 5-year rolling average. We can clearly see a couple of trends in this chart. One is that there's an overall increasing 5-year average, as noted on the blue line, but significantly higher price volatility, particularly towards the right-hand side of the screen. Note the steep decline on the right-hand side last year, going from 2014 to 2015. So in the next slide, we're now looking at net margin. So we have milk price again, which is the blue line, and then the red line is net cost of production. The vertical lines show the magnitude of profit or loss for each year. So there's a few things to note in this chart. A couple is previous peak margins. In 2007, we had a peak margin of $4.22. That was exceeded last year, in 2014, by giving us an average margin of $4.75. In 2015, due to that blue line making a dramatic drop, we resulted in an average net margin of negative 12 cents per hundredweight, virtually break even. In 2016, we can see the blue line continues to go down, which is the projected milk prices for this year. And then the red line, if net cost of production remains the same, then we're going to have a significant shortfall in 2016, which is very concerning. So in order to help reduce that unfortunate event, producers are going to really have to reduce their net cost of production this year. So moving on to another chart. This shows earnings in a little bit different way. Net earnings per cow since we began the dairy farm summary in 1979. The red line is actual dollars, while the dotted blue line is what we call real, or dollars adjusted for inflation. So if we put a trend line in, that makes a couple of things apparent. One is that net earnings have gradually climbed over this period, despite the extreme volatility on the right-hand side of the timeline. That means basically that we've seen higher highs and lower lows than we've seen in the past. It's important to note also, however, that although this trend line shows an upward slope, there's no guarantee that that upward slope is going to continue. In other words, it's really too soon to tell whether this current period of down prices is temporary and we're going to see a resurgence, or whether this is kind of a new normal that we're going to have to adjust to. If we shorten the timeline to make the slide a little cleaner, it shows that you can see the extreme volatility of earnings over the last couple of decades, as well as how that volatility has accelerated in recent years. So if we split this time period into roughly 2 decades, we can see that volatility has increased significantly. The left-hand side of the chart shows average earnings of $161 and standard deviation, which is a measurement of volatility, of $144. The right-hand side of the chart, in contrast, we see average earnings up at $414, but standard deviation went up significantly as well, resulting in a standard deviation of $409. What that basically means is that from that average, the actual profitability of any given year can vary by as much as $400 per cow from one year to the next, which is tremendous. So how have farmers adjusted to this situation? Mainly it's been by changing expenditures. Here we can see a couple of ways in which farmers have tightened their belts and reduced expenditures over the last year. On the left-hand side, we can see repairs and maintenance per cow. We can see that on the right-hand side of that left chart, from 2014 to 2015, repairs and maintenance dropped significantly, roughly reverting to the average of 2011 to 2013. That means that farmers put off discretionary repairs, and hopefully they got caught up in 2014 when they spent a little bit more money, or significantly more rather, on repairs and maintenance. It should be noted that if we look on the left-hand side of that chart over at 2010, that 2015 spending does remain historically high by historical standards. So although it was reduced from 2014 levels, it's going to have to be reduced more if we're going to maintain margins. On the right-hand side, we see capital purchases, and it followed a similar pattern. On the one hand, it's good that farmers are still investing in their businesses, that they're buying new equipment, that they're investing in property and plant. On the other hand, the current level of expenditure and capital purchases may be unsustainable. We can see that while it's significantly lower than 2014, it's still quite a bit higher than 2010. So this combination of earnings and spending patterns resulted in changes in financial position of farms. Here we can see how the producer's financial position has changed in the last year. On the left is what we call the current ratio, and basically that measures current assets versus current liabilities. So a current ratio of 1 would mean that the farm has roughly an equal amount of current assets compared to their current debt. And by current, we mean assets that are likely to be converted to cash within a year, and by current debt, we mean liabilities that are going to typically be paid within a current year. So it's a measure of judging how solvent a business is in the short run. So we can see that in 2014, as a result of the remarkable earnings year, farmers had a 3.5 point current ratio, which meant that they had 3.5 times as many current assets as they did current liabilities. That meant that they had large amounts of prepaids, perhaps some deferred income, full inventories, and of course cash savings. That level ratcheted down after 2015. So farmers basically began the year relatively flush, but 2015, because of the negative price environment, that basically chewed up a lot of that current assets. And we can see that, however, that at a level of 2.8, that's still a pretty healthy level. So on average, farmers are still in a relatively good position and able to meet their obligations. If we look at the right-hand side on net worth, we can see the red columns are assets and the green columns are liabilities. There's a couple of things apparent in this chart. One is the continued upward trend of the past 6 years, from 2010 to 2014, and that trend was reversed in 2015. Assets reduced and liabilities crept up a little bit. It doesn't look super dramatic on this chart, but the gap between the top of the red column and the top of the green column is what the farmer has for net worth. And it's important to note that many of the assets of a typical farm are fixed assets, such as land. So while the equity in land is beneficial if that farm is sold and they have to meet their obligations, you can't really use real estate equity to pay your operating expenses. So even a farm with very healthy net worth can still run into cash flow problems, which happened to some producers last year. 2016 is going to be more of a challenge because our period of low prices is continuing or perhaps even getting a little worse, but farmers do not have that strong cash position and that strong current ratio they had at the end of 2014. So here we look at some cost categories and some of the major expenses that dairy farms have, and many of these declined in 2015. Some of this was due to producers economizing on expenses, but other categories declined almost because of luck, basically because of falling commodity prices. So feed expenses fell by 11% per hundredweight, as you can see in this chart, and that was driven largely by falling prices for corn and oilseeds. Some of that may be a result of changing feed rations, but a lot of it was just strictly commodity prices declining. The same situation exists in fuel expenses. Fuel prices, of course, dropped dramatically last year, so farmers saved 37% on their fuel per hundredweight. Other expenses were perhaps a combination of belt tightening and falling commodity prices. It's noteworthy that labor declined slightly per hundredweight. That was entirely due to increased productivity per cow. If we measure the cost per cow for labor, it was basically flat, but because the cows that they were milking were themselves more productive, the cost per hundredweight declined a little bit. So another thing that's interesting to note is that we often talk about net cost of production as if it's a single number. We talk about an average net cost of production and average margins and that kind of thing. But it's important to note that the reality is that every farm really has its own unique cost of production. And each farm also has, to a lesser extent, its own unique milk price. They vary slightly from farm to farm. And of course, their own cost structure. And as you can see, the cost structures vary significantly from one farm to the next. This chart shows the distribution of net cost of production of farms in the Blue Book study. So the columns rise by the number of farms that reported net cost of productions within that range given. So on the left-hand side, we can see people that had low cost of production. There's a cluster around the average, and then the right-hand side are people that had higher cost of production than average. The black line represents the average net cost of production. Because that fell at roughly break-even this year, most of the farms to the left earned a profit with a lower net cost of production than average, while most of those on the right with a higher than average net cost of production generally lost money. Note that the farms are clustered near the mean, but the tail, if you will, is longer on the right-hand side, and we'll see why this is on the next slide. So this slide shows 2014's cost of production distribution overlaid with 2015's cost of production. And we can see that it's shifted to the left. If we look, I mentioned that long tail on the right-hand side. Basically what that represents is farms that were still at their 2014 cost structures in 2015. They just weren't able to reduce their cost of production to the amount necessary to break even or earn a profit last year. So many of these farms survived on their cash holdover from 2014. That's going to be a bigger problem this year because that cash holdover is largely gone. So now we're going to look at the distribution of costs within this cost structure. The red line is variable costs and the green line is fixed costs. And just to explain what that means for a minute, fixed costs are generally those that typically don't change a lot with increases in production. Things like bank interest, property taxes, insurance, that sort of thing that don't change if you add another 10 cows maybe. Variable costs are those that are directly tied to production volume. Of course, the number one is feed, labor, fuel, fertilizer, other things that typically increase on a more or less linear path as you increase the number of cows. So if we look at those two lines, we can see that while both categories are important, virtually all of the increase over this period has been due to increases in variable costs. At the beginning of the period on the left, we can see that the costs were split almost evenly between the two categories. Farmers paid about roughly $5 a hundredweight in fixed costs and roughly $5 a hundredweight in variable costs. That gap has widened over the last 20 years or so. And we can see now that fixed costs are roughly the same as they were quite a while ago, while variable costs have increased substantially. Not only that, but the rate of increase in variable costs has accelerated. We can see a change in the slope of the line on the left-hand side to the right-hand side. From 96 to 2005, variable costs increased at a higher rate than fixed, but not terribly so. That accelerated in after 2005 for the next 10 years, and we now see a big increase in variable costs. The takeaway of all this is that it means that managing cost of production in large part is about managing your variable costs. It also means another significant thing, and that's that it can be tough to grow out of a high production cost situation. Because while fixed costs are normally diluted by scaling up and spreading them over more units, variable costs tend to increase when production is increased. So that means that adding more cows is not necessarily the answer to a low margin situation if your variable costs are high. So we went through a great deal of information in a pretty short time there, but I'm going to go through a few takeaways here. The obvious one is that milk prices fell precipitously. That sharply reduced the profitability of Northeast dairy producers. It is notable that net cost of production fell somewhat after 6 consecutive years of increases. That means that producers tightened their belts across numerous categories, but some of those costs still remain high by historical standards. So hopefully there's room for further reduction in some cost spending, in some spending categories. Farmers will need to continue to do this through at least the end of this year and likely beyond. My final point is that this downturn is different from the rapid fluctuations of what we've seen in recent years. We'll talk about why that is in a minute, but it seems like dealing with this situation is going to be more of a marathon than a sprint. So looking ahead, what does the near future look like? This is a chart of wholesale milk prices. The line denotes the difference between actual and projections. The actual results are through March, and the projected is through the end of 16. We can see that the forecast is considerably more bearish for 2016 than it was for 2015. In 2015, we had an average roughly 17 and change, depending on who you're looking at. In 2016, it's down substantially by about $2 perhaps. So the annual average of 2016 is still likely to be substantially below 2015. So if we look at what the industry reaction has been to what's likely going to be an extended downturn, here are some of the reasons why that may take a while to recover. On the left, we can see the number of cows in the U.S. herd, and on the right-hand side, we can see total U.S. milk production. Now, there's a lot of noise in that chart on the right due to seasonal variation, but you can see from that trend line that the trend is clearly increasing for both milk production and herd size. So one of the factors involved in price recovery is going to be bringing supply and demand into closer alignment. Milk prices are low basically because we're in an oversupply situation, both domestically and international. And based on the direction of these trends here, as we can see from production, it doesn't look like it's getting better, at least to this point. Of course, dairy products are global commodities. There's an international component to this as well. But with the strong dollar and domestic prices higher than a lot of international prices, it looks like exports are not going to save the day. And the situation overseas is similar as well. We're seeing increased production in major dairy exporting regions like the EU. So unless global demand surges for some reason, it's likely going to take a supply correction to improve our economic situation. So speaking of that correction, this chart shows a tale of two downturns. What happened after the 2008-09 downturn and what's happening now. The blue line, it represents cow numbers in 2008 and 09. Starting on the left, you can see the peak price, and then going as we go over to the right, the months following that peak price as the milk price declines. And then the vertical axis is the herd size in number of cows. We can see the blue line started to trend downward and then became sharply downward, beginning about 5-6 months after the peak price, and milk started to decline, and then accelerated after about 11 months. And by 12 months after the prices began to drop, the herd size had contracted by about 150,000 head. If we contrast this to today, we're currently 17 months after prices began to fall from their peak in 2014, and the U.S. herd size has actually increased. Now, there's a number of reasons for this difference. One is that we had a herd buyout in 2009, and the price decline in 2009 was much more pronounced than the one we're currently dealing with. But the point is that nothing is really happening that's going to bring supply in line with demand anytime soon. And that's one reason why we may be in this situation for a while. So on that perhaps rather unpleasant note, we're going to conclude my remarks and see if there's any questions that have come in.
Great, thank you, Chris. So reminder, if you want to text in a question, if you go to the red arrow in the control panel screen of the GoToWebinar, you can type in a question. So I'm just going to give that a second, see if anyone has any questions about the dairy farm summary results themselves. And while we do that, and then before that, we'll, and once we've done that, we'll introduce our next panel to get some reaction for it. So Chris, while we're waiting here, what are, you've obviously worked on this closely, been very close with the data. What are some of the things that, maybe stood out to you and is, in the process of putting together the dairy farm summary?
Well, a major one, Tom, is that we had pretty significant variation. As I showed in that chart of net cost of production and the distribution of it, we had farms that, well, nearly half the farms in the summary lost money, at least some money.
Yeah.
A lot broke even, and then we had a few that made over $1,000 a cow.
Right.
So there was a lot of variation based on their cost structure, based on the milk price they were getting, based on a variety of factors. So it was not a good year overall on average, certainly, but there were still some farms that managed to have things align and were able to still make a profit last year, while a lot of them were unable to for any number of reasons.
Okay, great. All right, well, I think, so certainly if folks have questions on the dairy farm summary itself, we can certainly take those after we speak to our next panel, or we can leave those into that discussion. So right now, we want to talk to some farm credit east, some of our experienced lenders, managers out there in the field. These are folks who are working with customers every day. So let me introduce them all quickly, and we can get some names from them. So first we have Brian Moncton, who heads up Farm Credit East's Western region, managing the offices in Batavia, Geneva, Cornell, and Mayville, New York. So thanks for being with us today, Brian. We'll also be hearing from Craig Pollock, who manages the Sangerfield office in Oneida County, which is the part of the state of New York that I'm from. So welcome, Craig. And finally, we have Jan Bitt. She's the manager of our Portland, New York office, and we'll also be getting her insights as well. Should note that all three of these individuals work closely with dairy farmers in their respective areas, very experienced in managing the relationships with Farm Credit East members, and certainly because of their tenure with Farm Credit East have seen downturns in the past. So it'll be good to get their perspective on what they see from the 2015 results, as well as some insights in terms of what we should expect here going forward. So before we get into the questions about what to do going forward, I'd like to turn to each of them for kind of a reaction in terms of the data that's been presented. So I'm going to start first with Jen.
Thanks, Tom. I guess I was most impressed by that range in net cost of production, that chart that Chris showed, from $11 to $28. And as I think about the producers that we work with, and what's the difference between the lower cost producers and the high cost producers, some of my observations are that the folks who are better able to adjust their business during a downturn are using a lot of outside resources. So it may be a profit team involving their veterinarian and their banker and their nutritionist, but they're not assuming that they can continue to do things as they always have in the past. A second observation is that that group that is making adjustments is using their farm records rather aggressively to manage expenses and make sure they're staying on top of their farm's finances. So, you know, I think the day of managing your finances by looking at the checkbook balance are over. So I think it's the producers who have taken their destiny into their own hands who are better able to adjust to these times.
Okay. Thank you, Jan. Brian, what did you see in the 2015 results?
Good morning, Tom. Well, thank you for being here, and welcome to everyone. You know, when I think of 2015, I guess I kind of stand back and look at maybe the results in total, and I think of 2015 as, you know, maybe a year of transition. You know, we're coming through. If you looked at the dairy industry since 2010, anyway, you got 5 years there of, you know, relatively good margins and some good times. And I think, you know, 2015, we entered 2015 knowing that milk prices were coming down. We started to see that in late 14, but still really weren't sure what it all meant and maybe what the future held. And, you know, so I think that transition as we went through 15 and maybe realizing that, you know, maybe these milk prices weren't going to kind of give us that familiar bounce back that we'd maybe seen in previous downturns, you know, it certainly was a year of transition. And I think it kind of showed its way in how much people were able to move their costs, coming pretty close to $2 or something like that coming out of 14. And they were able to react, and depending on how quickly they were able to move some of those costs, they did bring a significant amount of cost out compared to 14. I think there's more to come. We're seeing that with our producers today, and so I think 15 was a year of transition as we kind of maybe get into a lower margin environment.
Okay. Well, thank you, Brian. Craig, anything to add? And obviously, Jen, Brian covered a fair bit of the landscape there.
Yeah, thank you, Tom. Good morning, everyone. Just a couple things. We had an intern in Sangerfield this past summer, Nicole Achtel, who built scenarios to model prolonged milk price downturns and their effect on dairy farm businesses with, you know, different near cash reserves, debt carrying capacity, existing debt, etc. And as we advised Nicole on that project, one of the assumptions was that capital spending in reality cannot go next to nothing. You know, a producer can postpone a new barn or a land purchase, maybe live off of depreciation for a while, but inevitably machinery and parlors wear out, and so there needs to be some sort of capital spending. The dairy farm summary, I think Chris went over this a little bit, you know, indicated capital spending of about $304,000 per farm in 2015, 5-year average at $288,000. If you boil that down on a per cow basis, $813 per cow in 2015 versus $845 per cow for the 5-year average. So, you know, there was updating in 2014 based upon strong milk prices. Producers rode into 2015 with much higher levels of near cash assets than what exists now, which made capital spending easier to justify. most producers' plans are limiting capital purchases in 2016, but I think it's going to be interesting to see what that capital spending number shakes out at for 2016, especially with larger equipment prices being soft, adding another variable to that mix. And then you have to wonder how much more depreciation will need to be addressed in 2017. Dairy farm summary, moving on to the second point, it tells us that management and cost control are the keys to success, not necessarily size. And so being a large farm is not necessarily a free ticket to profitability. There's a number of small farms that are in the top end of the range for profitability, which I think indicates there's more than one pathway to being successful. Thank you, Tom. I'll turn it back to you.
Yeah, thanks. So, Chris, why don't you weigh in on this? And also, a question did come in terms of kind of just the point Craig was hitting on in terms of, what is the trend? What does the farms that are lower in cost of production look like? What are the styles of production? So maybe you could comment on that as well.
Sure, yeah. Just first of all, a technical note on how we calculate net cost of production, because there's some controversy, if you will, in the analyst community of what should be included in net cost of production, what should not be. For the purposes of the dairy farm summary, we do not include what's called non-farm income. So things like a spouse's salary or something like that is not factored into cost of production. However, we do count what's called non-milk farm income, and that constitutes things like cull cow sales, they do some custom work on the side, perhaps they have a maple sugaring operation, various ancillary activities that are kind of embedded in the farm and can't easily be broken out as separate enterprises. That's not really a factor for most large farms, but for smaller farms, their ancillary business activities can be significant, and that would affect their net cost of production, because we basically divide the farm's total expenses by their production to get that net cost. So that is a factor in some of that distribution for some smaller farms. To answer another question about what a profile of a low-cost or a high-cost farm would look like, we tended to see the low-cost producers clustered in the larger end of the size spectrum and the smaller size of the herd spectrum. And basically what that means is that some smaller herds used a lot of family labor, kept their expenses to a minimum, grew most of their own feed, had a lot of other things that helped them on the expense side of the equation, perhaps also had some significant non-milk farm income. So that is one group of people that had low net cost of production. Another group of people is those that had an economy of scale, had a larger herd size, and managed their farm just really tightly, and were very aggressive in their cost control and things like that. So we did see a little bit of a cluster. The worst place to be, if you will, on an average at least, was 100 to 300 cows. That was the category that we saw the poorest financial results for last year at least.
Okay. And before I kind of turn it back to our panel for a couple more comments, Chris, a couple folks from the audience wrote in asking if organic farms were included in the data. And my understanding, organic farms are excluded from this particular study.
Yes, that's no slight against the organic dairy community in any way. It's just that the economics are very, very different. And particularly in a year like 2015, they diverged a great deal. So we purposely excluded farms that were organic from the dairy farm summary. We did not exclude farms that served other specialty markets, like for example kosher milk, or had non-Holstein herds or something like that. Mm-hmm. But we did not include organic farms.
Okay, great. So let's turn back to our panel. So we've sort of looked at the 2015 results. Given the current market conditions for 2016, where Chris pointed out the forecast for the rest of the year really doesn't look all that much better, what are some of the strategies that you see producers taking? What are the changes that some the producers are making in their operations? Some of you touched on them in your introductory remarks, but I kind of want to circle back to that. And I'll start with Brian in terms of what you're seeing with the customers that you're working with.
Of course, Tom, there's a wide range, of things that people are doing. People are entering this difficult period in different situations. But I think one common thing that I see is attacking, I'll say, the cost side of their ledger, and they're doing that by amping up. I will say their use of their professional teams that are around them, whether all the way through their management teams and ownership, but through the vet, through the vendors, through the lender, through all the profit teams, and being very aggressive and making, I'll say, greater use of what can we do to attack the cost side of our business, and I think that's getting them that next incremental piece of beyond just the fact. I think Chris kind of talked about, well, fuel just came down and that was great, but it was something that just sort of happened. But I think these types of things are going to get them that next dollar that they probably need to wring out of their business, is really amping up their use of all the professionals around them.
Okay, great. Craig, anything to add on that?
Sure. Related to Brian's comment there regarding cost control, I'm seeing producers more willing to develop budgets and review them. They're putting much more focus on managing the cost side of the business, determining if their resource base and assets allow some avenues to diversify income. They may have some advantages with, let's say, a land base that is beyond what they need for the dairy, and so maybe crops, aren't the greatest, but it's a way to sort of maybe smooth out and lessen the reliance on milk check. As I indicated before, deferring capital purchases, you just wonder how long that can hold out. And we're seeing folks come to us and say, is it wise for us to utilize the equity in our real estate to get debt service requirements relaxed? And that's something that we need to take on a case-by-case basis with each producer. So I'll kick it back to you, Tom.
Jan, anything to add on this particular one?
Sure. If we want to take a look at the glass being a little bit half full, you look at the overall financial position of the dairy farms in the Northeast going into this downturn, and they're really in a strong equity position. 72% net worth is a very strong place to be. And if you look at the capital spending over the last 5 years, it's averaged more than $4,000 debt per cow, but over that same period of time, the debt per cow has only gone up by $500 a cow. So what that says to me is that businesses have been reinvesting their profits into the operation, and in a year like this, as Craig mentioned, there may be opportunities to pay you back for some of those capital items that you paid for out of cash flow that now you wish you hadn't, because it hampered your working capital. So overall, I wouldn't be as gloomy as some of these charts suggest.
Okay, well, that's good to hear. And actually, I'm going to turn to Chris for a comment on this as well. There was a question that came in regarding how we calculate current ratio, and the question was whether or not current portion of long-term debt is included in the current liabilities, and that is the case, correct, Chris?
Yes. Yeah, we break out the current portion of long-term debt and put that into the current liabilities to compute the current ratio.
Okay.
Another thing that I was going to mention that was kind of interesting to me was for some of the farms that economized on expenses, a couple of categories where they tended not to economize on and still got good results, where some of the farms that were highly profitable also had relatively higher feed expenses than the average, not by a lot, but by some, which indicated that they weren't just cutting back on their feed sort of arbitrarily. They were trying to optimize their ration for productivity. Of course, there's a diminishing rate of return there. We had some farms that were very highly productive but not that profitable, meaning that they're maybe overspending in that category. But it was notable that across the board, the top profit category didn't necessarily just reduce their feed expense, across the board arbitrarily. Another one that was interesting too is labor. The farms in the top profit quartile didn't necessarily spend less on labor than farms that were less profitable. And that indicates to me that they're investing in their employees. They maybe have better employees. They got more, those farms tended to get more productivity per employee. They had higher milk production per worker. So that indicated to me that it's not just about finding the cheapest guy to work for you. It's about finding the most efficient mix of employees.
Okay, great, thanks. So we're getting a bunch of good questions in here, so I'm going to take some of these and try to work through our panel in terms of some responses to them. And again, they kind of cover the range. One here is really more about, I would say, the macro situation in the New York regional milk market, asking if, what's the impact going to be in terms of expansions of processors, in terms of, I think, really looking at the regional supply and demand. And I guess I'll offer a comment here first, in which, to the extent that processors in New York State are expanding, that's certainly going to be a good thing. Yeah, I was one of Farm Credit East prepared a report last fall looking at some of the milk marketing challenges in the spring of 2015, where there were situations where there actually wasn't enough processing capacity, and to the extent that the processing capacity we had was really strained. So I think that will be certainly a good thing in terms of the local milk market, to the extent that we see new processors coming to New York State or those expanding on it. Brian, any comments on that particular piece?
Well, I would kind of go back to one of the things that producers are doing to get through this situation. Probably the number one thing that they're doing is producing more milk on their farms, or looking for ways to do that. And for a lot of those operations, that's absolutely the thing they ought to be looking at. Optimizing their facilities, or if they have a good variable cost structure, maybe even some growth as they sort of optimize assets as well. So that's the right thing for them to do as individuals. As an industry, certainly, there is some talk that there might be a little bit of a spring flush problem, and we'll see how that plays out over the coming months or so. But I think as you said before, Tom, I think generally speaking, we do have the capacity, albeit kind of at its limit on the processing side. But from a lending perspective, we continue to look at the individual producer and what makes the most sense for them.
Great. So we had a couple questions come in related to the CWT, the Cooperatives Working Together program. Chris, in his comments, talked about sort of the overall herd reduction in 2009, and some of that, I believe, was financed through the CWT program. So someone asked, what are the deductions being used for now? Chris?
Okay, yeah. Basically, CWT has tried to align supply and demand more closely to help improve prices. And in 2009, that took the form of trying to do a herd buyout and a herd size reduction. What they've been doing now with the CWT assessment is promoting exports. So, if we're in a current oversupply situation domestically, one of the answers to that is to try and move product offshore. And CWT has done that by helping to support exports, mainly of cheese.
Okay, great. And someone else had asked this, if there was the potential for another buyout. I think that's unlikely. I know there were some legal challenges related to the first
yeah,
one.
There's still some outstanding, I would call them maybe nuisance lawsuits against the CWT for allegedly colluding to increase milk prices. Mm-hmm. Given that those are still unresolved, as far as I know, I think it's unlikely there'd be another herd buyout anytime soon.
Okay. A question came in, and I'll turn this back to each of our panelists since they kind of cover different parts of New York State. But what are they seeing in terms of the values of tillable land with relation to the milk price situation right now? I'll start with Craig and then go to Jan and Brian.
I would characterize, the value of good quality tillable land. It's maybe softened a bit, Tom, but not overly so. And I think we need to keep in mind that some producers are taking advantage of the opportunities that a down market can offer. They, went into this downturn with a balance sheet that was really well positioned, and so there are buyers for good tillable land. So there's still some demand there, but as I indicated, I would maybe a little bit of softening, but I wouldn't characterize it as being overly such.
Okay. Jan?
Yeah, where in areas where there's good land that sits between two, fairly strong farms, we're seeing very high values, higher values than we've in fact seen before. I would say there's much less competition for the so-so land, and in the southern tier, where there was a lot of speculation over gas rights, and people are done speculating about that, those values we saw take a fairly sharp drop last year. So it's very dependent on the competition in the neighborhood and the quality of the land.
Sure. Brian, what are you seeing out in the western region?
I don't think it's anything different than what Craig or Jan said. There's still where land is in a highly competitive area. There's still a strong desire for that, and so maybe a little touch softer perhaps. Will there be a few less high sales? I don't know, or sales in general. I don't know, but I wouldn't think anything of a serious note there yet.
Great. So we had a question come in terms of what is the average term of debt, and how does this relate to farms adjusting cash flow needs? Again, I think in different ways you all may have touched on it. Jan, why don't I let you handle that one?
Sure, thanks.
Sure.
Yeah, I actually went and looked that up, and it looks like the average, what we call blended capital debt term for farms in the dairy benchmark is a little over 7 years. So that blended capital debt term means how long would it take the farm to pay off all its debts if it just kept paying at the rate it is now and didn't borrow any new money. So 7 years is a fairly reasonable debt term for a farm in general. We'd like to see it at less than 10 years. So that does suggest that there is some room for lengthening out debt terms in the short term.
And that's something that might be able to help with cash flow when we hit a year like 2016.
Exactly.
Gotcha. Okay. Question came in on the TPP, the Trans-Pacific Partnership. That's a trade agreement that's been negotiated among obviously countries on both sides of the Pacific Ocean. I believe it has been agreed to, but would need to be passed by Congress. Is this going to help or hurt dairy farmers? I think I would defer on that question. I think it's a great question. I think a little beyond the scope of what we're talking about today. I would say that my understanding is the National Milk Producers Federation has come out in support of it, but I would also just note that I think with the election year, it's unlikely to be acted upon this year. More of a technical question here next for Chris. Talks about how much income in 2015 was deferred from 2014, and does that get accounted for?
It does get accounted for. There was substantial farm income, mainly milk checks. I would say almost perhaps even most farms deferred their December 2014 milk check into the following year for tax purposes.
Sure.
However, we adjust for that. We make what's called an accrual adjustment. So we accounted for the money when it was earned, even if they deferred the payment, the actual payment, until a later year.
Okay. And I guess while we're on technical notes, it's discussed in here about, it's noted that in 2014, Vermont was not included as part of the dairy farm summary, but is included in 2015. However, 2014 numbers were adjusted. And Chris, if you could just speak to that.
Yeah, we basically went back in retrospect, and Yankee Farm Credit was extremely helpful in terms of getting the data from Yankee for 2014 and 2015, and we merged the data together, the data sets together from Farm Credit East and Yankee. And in the Blue Book, we restated the 2014 results so that the comparisons are valid. However, having said that, the differences weren't that big. I would say it was maybe less than a 5% variance on most categories.
Okay. Okay. Great. And then you mentioned before about government programs, things like conservation payments and things like that. Where do they get included in the?
Okay, beginning in, I believe it was 2013, we broke out a special line in the income section of the Blue Book charts for government payments. Prior to that, they were included in other revenue. So we felt that the government payments were interesting enough and significant enough that they deserved their own line item. Mm-hmm. In that government payment line are things like conservation payments, any kind of direct subsidies, that kind of thing. Crop insurance indemnities, if there are any that are received, go under crops for that income line. And if they get a significant grant, like say for a manure storage pit or something, an NRCS cost share, that would be paid in capital and wouldn't appear as income. So they go into a few different things, but basically what we would consider direct government subsidies are under government payments, and they're itemized separately.
Okay, so even if it is, say, a cost share reimbursement, it would go into that column, like a conservation program.
Yes, yep.
That payment. Okay, good. Question came in about risk management tools. And the 2014 Farm Bill, the margin protection program was established. Then there's also the crop insurance LGM dairy program. So I want to get a comment from our panelists at what they're seeing producers doing in terms of contracting or other sort of price risk management efforts on their part. And so in this one, why don't I start with Brian and then go to Craig.
Well, I think we certainly saw the impact as we looked at individual producers that had, I'll say, started those practices or maybe continued their practices, you know, in 14 coming through 15, and you could see the differences in, you know, in their net income line, because maybe what they you know, quote took off the top in 14, they maybe got some of that back in 15. I think, you know, certainly as we've headed into 16, you know, I'll make a general statement and say maybe people seeing maybe a little less opportunity there, so maybe a little less usage. I guess I would put it that way, Tom.
Sure. Sure. Craig?
Yeah, I'd reiterate what Brian indicates. I don't see anybody, you know, making a move to, you know, accelerate the use of any contracting. I think folks were disappointed with the, you know, margin protection program. I think probably they're further ahead with management of expenses than they are on the income side.
Okay, great. A question that came in, and it kind of relates back to something Chris had mentioned regarding, as you look at the size breakouts of the farms within the summary, and that, you know, in a sense, the kind of on average, the worst results came in sort of the 100 to 300 cow farms. So I'm going to turn to the panelists here and ask, what would be some of the thoughts maybe for farms in that specific size range? Again, not that you can overgeneralize them as well, because each of those operations are going to be unique. But maybe some of the ones for farms in that range in terms of managing cash flow or other strategies for success. I'll start with Jan and then go to Craig and Brian.
I think many of those operations are probably, from a cash flow standpoint, doing better than the study shows because they don't include non-farm income in the summary. And I think many of those farms are hanging in there because of the non-farm income that's helping. Above and beyond that, I would say folks who are working with neighbors to share equipment, we see some of that going on, or using custom operators rather than investing more heavily in equipment on their own. There are ways that they can trim costs by being a little creative.
Okay. Craig?
Yeah, I would second that. I think, you know, we always find when we get into these down cycles, you know, that I don't know. I think we're always amazed at the resilience of dairy producers. They find ways to tighten the belt, much as what Jan has alluded to. And I think when margins get tight, they get get a little bit creative and find ways to cut costs.
Okay, great. So another question came in, and I'm just going to kind of paraphrase it. I think it's a little bit more a comment than a question. I think is, well, I don't think we want to go too far down this road. It's certainly worth mentioning. As we've talked about the importance of, certainly over the last decade, the importance of exports in terms of the dairy pricing situation, and that becoming a larger part of where U.S. dairy products go. And over the last few years, we've seen a decline on that, which certainly has something to do with the price situation. That I think the comment is that given that the export market has always been looked at as a place to put our excess dairy products, should that really be more considered in terms of our national dairy policy, in terms of making exports a little more central to it, in terms of the pricing formulas, as well as how Class 1 milk or fluid milk is treated in terms of the premium that it's gaining. So I think that's an interesting comment. Again, I think a little beyond with what we're talking about today, but certainly something that's interesting to consider. So one more question here, and I think we'll start to maybe just kind of wrap it up. We've got just a couple more questions. I think we've had a great discussion here. We'll kind of turn around. I'll go back through one time for closing comments. Question in terms of I think more specific to the margin protection program, in terms of the outlook for that for 2016. And a question that came about that said that really the comment is, given the options under margin protection being $4 to $8 in terms of what, based on the national formula, appears to be small, as there have been sort of relatively few payments made under that program. And so I guess the question is, for the group, what, for those who have used the margin protection program, have any bought up to that level and receiving payments? I want to start with Brian. Have you seen folks who are using that program, or?
Yes, definitely. People use that, because they were able to, in their mind, see the opportunity, particularly earlier on in this cycle, where they thought that they could, and they did buy up, and they did get some payments in 15.
Okay. And I guess it should be noted too that we have the livestock gross margin risk management product as well, which is different. And I know as you go back to 2014, I know Chris and I had spoken about the fact that because I believe that's based more on futures prices, there were some times as the price decline started in 2014 that there were some opportunities to
people, the producers that utilized the LGM dairy program last year generally fared better, if you will, than the people that were on the margin protection program. As you know, the Farm Bill requires you to choose one or the other.
Right.
So once you go to MPP, you can't go back. Although you can switch the other way. You can go from LGM and then opt into MPP, but you're not allowed to return. There's a little less opportunity now than there was a year ago on the LGM dairy program because of that futures component, like you mentioned, because the futures are not looking good right now.
Okay. Comment came in, question about the New York State, and I know some other states are looking at this as well in terms of increased minimum wage. What a potential effect that could have. There again, certainly people are welcome to, the panel could chime in on that, but I think certainly as you look at the cost structure, as the minimum wage increases start to step into effect, that's going to hurt the cost structure in terms of the kind of wages dairy farms are having to pay their employees. So that's an interesting comment, and one that Farm Credit East Knowledge Exchange did prepare a report looking at the potential impacts of the proposed minimum wage on all ag sectors, and you can go to farmcrediteast.com to take a look at that report. So I think we're hitting about the end of the questions. I'm going to go back one more time to the panel and to Chris for some closing comments. So I'll start with Craig, and then Jan, and then Brian. So Craig, what are your thoughts?
You know, first of all, in the 36-year history of the Dairy Farm Summary, if I read it right, 2015 ranked 29th in terms of profitability. So, you know, let's try to get some sunshine on this thing if we can. There were 7 years out of the last 36 where profitability is worse than 2015, and we're all, you know, the industry is still here. I want to reiterate on something that both Jan and Brian touched upon, and I think it's really important too. I think producers need to arrange for consultants and outside experts to work with on an ongoing basis, and not just during tough times either. So they can position the business to improve operating performance, become better positioned to weather downturns. To me, the successful producers recognize that you know, volatility, this thing's much more complex both within and outside their respective businesses. You know, that dictates that they really seek out new ideas and potential solutions beyond their farm gate. You know, last thing to me, and maybe Chris can chime in on it, you know, I'm not a milk pricing expert or a dairy economist, but to me, a bellwether event was when, you know, the European Union abolished their quota system last year. I think we're finding that producers in Ireland, Germany, the Netherlands are going to increase their supply, and, you know, long term, there's just going to be a lot more milk to displace in the global market. So I think we're probably on the cusp of some sort of different pricing cycle. Don't know exactly what that is than what it has been. So those are my closing comments, Tom.
Great. Well, thank you. Jan?
Yeah, if there are producers on the line, I'd like to say that, you know, it's kind of a natural reaction in times of tight cash flow to say, I don't want to talk about it, I don't want to think about it, let me just get out in the field. But it's really important that you talk with your lender about cash flow problems that you're having, because there may be things that we can do that will make your life easier, and the situation may not be as dire as it feels.
Okay, great. Brian, I'll let you have the last word for the panel.
Well, thanks, Tom. You know, I certainly echo what Jan and Craig said. I think, you know, I go back to where I started at the beginning. I think 15 was a transition year, and I think producers made a lot of progress on you know, bringing their costs down. Lots of ways to skin that cat. You know, you can do it with more milk. You can do it also on the other side of things, on the cost side of the business, and you can do it by finding other sources of revenue. And you know, dairy farmers have proven time and time again that they'll get that figured out. And I think that you know, as we go through the rest of 16 and into 17. You know, we will continue to see that progress on that side for those producers, to see some more of that cost come out of their business and what it takes. I think the trick for those is to try to figure out, for those that, you know, maybe have you know, enough leverage on their balance sheets, to try to see if you can get through that without growing the debt. Easy to say, tough to do. But I think if you can do that, we will see these margins, you know, normalize at least to a little more positive number here at some point.
Okay, great, Brian. Thanks. And again, I appreciate all three of you weighing in to provide your perspectives on the current situation. Chris, a couple of closing thoughts from you?
Sure. I had a few thoughts. One is to address a few questions that have come in, is where they can get the Dairy Farm Summary Report. That will be posted on our homepage at farmcrediteast.com probably by the end of today, as well as the recording and the slides from today's webinar. That will be at farmcrediteast.com/webinars. So both of those items will be posted by the end of the day today. Give us a little bit of time to do it, but we'll have it up there. So that's available. And printed copies, the report it's done as a PDF. It's still at the printers, but printed copies will be available in branches relatively soon. So that's that. As far as the actual sort of summary thoughts, I had a couple of quick ones. One was that a situation of sustained operating losses where the losses continue for, say, more than a year is a sign in my mind that something needs to change, and because the path is not sustainable. And so I think that there's a few things that are important for that. One is communication with the lender, whoever it may be. I think a lot of people are afraid to talk to lenders when their situation takes a turn for the worse, but the earlier the better when that happens. It's a time when you need to really take a look at everything you're doing and see, okay, what needs to change to reverse this trend? Because just continuing on it and capitalizing operating losses into debt is not a long-term good strategy. So that's my thought.
Okay, great. Well, again, appreciate everyone's participation here today. As Chris said, the report itself will be available very soon here at farmcrediteast.com. And we appreciate you joining us today for the Dairy Farm Summary webinar. Thank you and have a great afternoon.